Welcome everybody, my name is Matthew Cassidy, Managing Director, and I'm joined by Phil Almeida, the CEO of Performance Property. And we're here today to talk about the impact on the Australian property market as a result of COVID-19. Welcome, Phil.
Thanks, Matt.
Phil, could you maybe give us a bit of a summary about Performance Property and what you do in the property market?
Yeah, great. Well, we've obviously started a research and data analysis business 7 years ago. We help our investors build their portfolios across the country. We mainly operate in the established housing sector,
yes.
And we help our high net worth clients build their residential and commercial portfolios across the country. And we also manage their assets internally. So we have a PM side.
What are we seeing happening in the property market as a result of COVID-19? Are we seeing huge crashes at the moment? Have we felt the impact? Can you give us some feel for what's happening out there?
Yeah, well, it's really important that this particular downturn is a productivity downturn. It's not a financial downturn. So provided the credit's still flowing through the system, this is obviously very triggered towards unemployment across the country. So this discounting and panic selling that people are talking about isn't actually occurring yet. People are retaining, they're holding their assets, both in the commercial and residential sectors. We'll see the retail sector struggle a bit, so landlords will need to reprice if they're looking to rent out some of their properties across the board. But across Australia, we've never seen, when we get out of this, Melbourne, Sydney, Brisbane, they've never been so affordable. So I think if anything, your ability to get funding at the moment is 20 to 40% cheaper than what it was 12 months ago. And we're seeing there's going to be a real ability to actually buy quite well and upgrade your asset if you've got that budget of between 2 and 4 mil in the residential market.
Yes, okay. What about the construction industry being impacted by COVID-19? Will there be a supply issue, and are supply chains being impacted by what we're seeing in China?
Yeah, well, pre-COVID-19, we had a big issue with developers trying to get funding out there. So there's what we think it's going to create over the next, say, 12 to 24 months. There's going to be a serious undersupply of housing stock. The construction industry right now is probably one of our biggest industries, and we think it's going to get hit fairly hard as a result of this.
Yes.
So we've already got a national vacancy rate of around 2%. There's a serious undersupply of housing and a shortage of accommodation. So I see the banks will probably have to ease their restrictions in terms of developers being able to get funding, because we want construction to continue.
Yep. On the ground, what are you seeing happening in the Sydney market firstly?
Well, Sydney market, I'm actually starting to see some discounting occur at the top end, so that in between that $5 to $10 million space in the residential space. Commercial at the moment, where we're obviously not investing fairly heavy in the commercial markets up there. We think the market that you should be playing in Sydney is probably around that, say, 1.5 to 3 mil mark. We're seeing a lot of value in that price point at the moment. Rents at the moment, if you look at the rental market, we're going to see some sharp increases with obviously Airbnb just being terminated at the moment. So there's going to be a lot of worried landlords that can't actually convert some of those particular properties to long-term leases.
Yes. Yep. And what about the Melbourne market? What are we seeing playing out in the Melbourne market?
Well, Melbourne, like Sydney, is very segmented. I think the price point between, say, 500 to 1.5 mil in the investment space, that's still staying quite strong. We're seeing results where assets are selling at the lower end of the agent's quoting range. We're not seeing assets go for 20, 30% above market at the moment. I think there's real value right now in Melbourne between that 2 million plus price point. So we're advising our owner occupiers that have the capacity to upgrade to start planning for this now, speak to their brokers, look at their funding options, because we're seeing that the ability to access credit's a lot cheaper than what it was 12 months ago. Yeah. Bayside at the moment, there's good opportunities in Bayside. We haven't seen the discounting creep into the inner eastern suburbs, but we're still seeing a lot of value, and we're trading off market. So agents aren't doing open for inspections. They've cancelled auctions at the moment, and we're seeing a lot of value with our ability to kind of transact off market at the moment.
Yeah, right. And you've had some particular interest in the WA market, particularly Perth, over the last sort of 12 months or so. What are you seeing playing out in the Perth market, and why do you think Perth is possibly open for business after probably a long period of uncertainty over there?
Well, Perth's been down for 11 years. We've got an affordability index. We haven't seen the affordability index this low in 11 years. So 24% of an average person's income is going to service home loan debt at the moment. We're seeing iron ore, obviously the demand for that with the Chinese economy needing to be stimulated, so demand for that's picking up. Gold as well, we're seeing obviously a lot of gold in terms of interest in that particular market. There's really good value in the Perth market for the first time in a long time.
Yes.
We're taking a very strong position in Perth over the next, say, 2 to 3 years, and we think it's probably going to be one of the better performing residential markets over the next medium term.
Yeah. What are we seeing with, obviously there's been also some government mandates around people not being able to kick their tenants out. We've had people asking for rent. How big a concern is this, giving consideration to a potential property investment at the moment?
Yeah, so if you're an investor, we've been telling our private clients to make sure they've got their cash buffers, they're effectively running their cash buffers effectively. Obviously, state and federal governments are unified in terms of their approach, handing out rent relief packages. We've seen the $500 million rent relief package come out here in Victoria. There's $440 million in Sydney and $400 million in Brisbane. We currently manage in excess of 1,000 properties already, both commercial and residential. We had 80 cases last week with tenants, both commercial and residential, claiming hardship. Our PMs and our department head property managers are speaking to our landlords, speaking to our tenants. We need to make sure the communication lines are positive, and we're down to 20 cases now. So provided we're willing to work with our tenants, we're working through this particular, and obviously state governments are playing ball as well.
Yeah. If any investors are looking at property investment, like how do you see the next 6 months, 12 months and 18 months playing out? Should we be looking to buy now, or should we be getting ready with a view to be purchasing with a little bit more unsettlement in the economy? What's your thoughts on that?
Yeah, it's a good question because no one knows actually where this will actually go.
Yes.
In our opinion, we rely on the data that we've built internally as a business. We look at the long-term fundamentals of these assets. We don't buy questionable assets. So from our end, we're looking at assets that are, provided they're going to be good quality housing stock, assets that we can manufacture or add some value to. They're easily rented. We're not buying in areas that are dominated by high percentage of renters. We like a good percentage of owner-occupier activity. Yes. In those areas. So we see a lot of value. We think clients should be gearing up and getting prepared to buy. The regionals here in Victoria are offering great value at the moment because they are little hubs within themselves. We've had a very strong focus on the healthcare and education industries. So we like buying in industries that are underpinned where we can get good quality tenants and cash flows protected.
Yes.
So these next 6 to 12 months cash flow is going to be fundamental. So
yes.
Having the right cash flow management, cash buffers in there is imperative that the client can retain and hold that asset long term. Yeah. So there's going to be really good opportunities that we're seeing.
Can you tell us a little bit more about your research? It's a really unique proposition where you assist clients acquiring property, but based upon a research business you've been investing in for a number of years. Can you tell us a little bit about that, please? Yeah,
so we've got 8 analysts that we run probably just over 40 metrics in each particular cap city and the top population centres around the country. We send that research out quarterly to our private clients. We rely on that data to make our investment-based decisions across the country. That only allows us to buy in certain pockets, so we are driven by that data. So we look at money supply, we look at obviously affordability indexes, credit, unemployment, underemployment. There's an iron ore, obviously WA's got certain, so each particular cap city is different. So if you don't have that research and it's not properly researched, this is a very dangerous time to be making decisions that aren't research backed.
Yeah, 100%. And we're seeing obviously some unbelievable interest rates at the moment. I mean,
yep.
We've seen some talk over the last couple of weeks of even some 1, 2 and 3 year fixed rates at 2.2, 2.3, 2.4%. depending upon your bank relationship. And what's this doing to yields? Are we seeing a huge reduction in yield, or what rents people will pay, or is this just a period of time where you can lock in some rates and really magnify your returns?
I think there's a really serious opportunity, because we're seeing obviously interest rates obviously a lot cheaper, 20 to 40% cheaper than what they were 12 to 18 months ago. So we're advising our clients to go and speak to their banks, speak to their brokers, start to gear up to make sure, because credit is, we've never seen it this particularly cheap, and it's a real opportunity to start taking advantage of really good buying opportunities if they've got capacity and their cash buffers are run effectively. So we think it's a really opportune time.
Yeah, great. Phil, thank you very much for joining us today. If anybody has any interest in meeting Phil or one of his team members from Performance Property, please contact your financial advisor, and thank you very much for joining us for the property update. Thank you.